So the next opportunity we're going to teach about is using oil or natural gas in limited partnerships. The advantages of this is there's a very significant upfront tax deductions that potentially can help lower clients' current income taxes. There's also potential for non-correlated long-term tax advantages, creating an income stream through these types of partnerships. Now, to be upfront, most of these partnerships do require you to be an accredited investor. That's either $200,000 a year as a single taxpayer or $300,000 as a joint taxpayer for the last 2 years and including this year. That is one of the requirements. The other requirement is $1 million of assets to exclude your primary home. So look at the potential tax advantages here. So when it comes to oil or gas drilling, the big thing that the IRS does allow for is the intangible drilling cost deduction. And depending on the partnership, that could be anywhere from a 50% to as high as a 75 or even an 85% tax deduction off of your investment. It also has accelerated depreciation that's there. And of course, the depletion allowance that's also allowed as well. And I'll talk that in further slides. And of course, we think the last advantage is the growth of those tax savings that you have if you reinvest the money that you are saving on your taxes. So the potential drilling costs, this is an upfront tax. Typically, on some of the opportunities we work with, this does come through a K-1 that's distributed, but approximately 60 to 80% of the amount that you invest on your current year could be used as an above the line tax deduction. Again, this could be offset your adjusted gross income. This could also be used to offset any capital gains from a sale of a business or highly appreciated stock as well. Second potential advantage is the accelerated depreciation that comes along with this. So oil and gas limited partnerships, they can utilize an accelerated depreciation. So you can receive a potential another deduction in the second year of up to 12%, between 10 and 12% of your investment on the following year. And then other neat thing about with this is that because it's part of the tax code, it does allow for a 15% of your distributions to be tax-free. So these investments, the return of capital, it is actually taxed. It is 85% of your income you're receiving from these types of investments do come with a tax opportunity. And then there is the 15% tax deduction that you get on these distributions. And last but not least, we do believe that there is, of course, if you take the money that's not sent to the IRS, and even if you put it in a bank account, money market account, earning 4 or 5%, that is your growth on your tax saving that you are able to be allowed. Now, the next section